Tell me if this sounds familiar. You buy a stock, it drops 40%, but instead of admitting you were wrong, you hold it on to for 3 years, telling yourself, I just need to get it back to break even. Meanwhile, another stock you own goes up 25%, you instantly panic sell it to lock the profit. A year later, you check the chart and the company you sold is up 400%. Or maybe you have done this. You watch a company stock chart go completely vertical. You don't know actually how this company makes money, but your friend just made 10 grand on it. The feeling of missing out physically hurts you, so you finally buy in, right at the absolute peak, the day before it crashes. If you have done any of these things, you aren't a bad investor, you are just human. Every textbook assumes you are a perfectly rational machine that flawlessly calculates value, but the truth is we are biological creatures running on ancient hardware driven by fear, greed and ego. Today I am going to tell you a story about how your brain is actively sabotaging your wealth, uncover the 5 hidden psychological traps that caused it, and most importantly, I am going to show you how to build the exact systems to outsmart your own mind. The first psychological trap, herd behavior and FOMO. Suppose you are at a dinner party, scrolling social media, and everyone is talking about a revolutionary new tech company. Let's call it Aerotech. Every trap starts this way. Aerotech has zero revenue, but the stock is up 150%. You ignore it at first, but then your co-worker buys some new cool stuff with the profits they made on this stock. The primitive part of your brain takes over. The pain of missing out overrides all the logic and you buy the stock at 200 rupees a share, which is its peak. This is called herd behavior. This is the engine behind every asset bubble in the history so far. How to survive herd behavior? The only way to survive this is by building a valuation firewall and a 48-hour quarantine. So whenever you hear a hot tip, you enforce a non-negotiable 48-hour lock before you are allowed to buy. Till then your adrenaline dies. Second, the firewall. Establish strict rules of when you buy or when you sell. If a crowd has pumped the stock to a price to sales ratio that violates reality, your system should automatically reject it. You don't ride the hype, you protect the capital by following your own rules or system. Second, anchoring bias. Suppose you bought Aerotech at 200 rupees. 3 weeks later, the bubble pops, the stock crashes to 60 rupees. A rational investor would look at the business model. If it's broken, he walks away. But you don't. You look at that 60 rupees price tag and think, wow, it's so cheap. It used to be 200 rupees and now it's trading at 60 rupees. It's so cheap, let me buy more. So you actually buy more. This is called anchoring bias. Your brain fixates on the first piece of information it receives. That 200 rupees is an all-time high and the stock will rebound to that price. But the market doesn't care about the past. The macroeconomic environment changed and the growth of that stock died. The stock isn't cheap, it is accurately priced for a falling business. How to fix anchoring? The fix is zero-based valuation. You must aggressively erase the historical price chart from your mind. Evaluate the company purely based on forward-looking fundamentals, the current cash flow, balance sheet health, and the future revenue. Ask yourself, what is the business worth today? The past price is a ghost. Do not take your decisions on past price. The third trap is confirmation bias. Say you own a good quantity of a share called Aerotech and the stock keeps dropping. Deep down you are terrified, but instead of looking for the truth, you look for comfort. You join specific Reddit groups, you only read articles that validate your thesis. When a renowned analyst publishes a report exposing the company's massive debt, you dismiss it and call it a market manipulation. This is called confirmation bias. You have built a fortress around your bad decision. You only search or agree to the info that makes you feel good. How to overcome confirmation bias? To destroy this bias, you have to use a strategy called inverting the search. Usually when you like a stock, you go to Google or YouTube and type why Aerotech is a great company or a great buy. You are literally asking the internet to feed your bias. Instead, force yourself to search for the exactly opposite thing. Search why Aerotech is a terrible company. You must find and write down 3 legitimate data-backed reasons why this investment could fail. Because the goal isn't to find a perfect company with zero flaws, because that doesn't exist. The goal is to know exactly what those flaws are before you put your money on the line. Because when you know the risk upfront, you don't panic when the bad news hits. You say, I expected this, and you stick around to your plan. The fourth trap is sunk cost fallacy. Suppose you are holding a stock, say Aerotech, since 3 years. You bought it at 200 rupees and now it is trading at only 20 rupees. The company is effectively dead money. You know it's over, but when you hover your mouse to the sell button, you freeze. You think, I can't sell now. I have held this for 3 years and I am down 90%. I have to wait. This is sunk cost fallacy. Your brain desperately wants to avoid admitting that a multi-year thesis was wrong. But the market does not care what you paid for it, and it doesn't care how long you have been holding that stock. To escape the sunk cost fallacy, use the clean slate test. Look at the dying company you are bleeding money on and ask yourself, if I had to put fresh cash right now, would I allocate it to this stock at today's price? If the answer is no, hit sell, deploy that capital in a business with an actual future. The last psychological trap, loss aversion. Say you have a stock called Aerotech that is down 90% and you also buy another share called ValueSmart with a brilliant cash flowing business. Now a year later ValueSmart is up 30%. You are so desperate to feel like a winner that you instantly sell it to lock the profit. Over the next few years, ValueSmart goes up to 500% and you miss it all. It's called loss aversion. The psychological pain of losing money hurts so much more than winning feels good. So we hold our massive losers to avoid feeling the pain, and we sell our massive winners prematurely just to secure a psychological victory. How to avoid loss aversion? The only way to capture massive compound growth is thesis driven execution. Before you buy a single share, write down 3 fundamental reasons of why you are buying. It can be profit margins, market share, leadership, or valuations, or any of the good stuff. You are allowed to sell only if those core thesis points breaks. A dropping stock price is not a reason to sell, and a 100% gain is not a reason to sell. If the business fundamentals hold, you hold that stock. The story of Aerotech happens every single day. Amateur investors try to fight these psychological traps with willpower, but professionals don't rely on willpower. They are architects. They build systems, 48-hour quarantine, zero-based valuations, thesis-driven rules and systems. They protect their capital from their own biology. Now let me tell you an interesting fact. These 5 traps do not stop at the edge of stock market. They dictate your whole existence. The sunk cost fallacy is the exact reason you stay in a toxic relationship or a miserable career for years, because you have already put up so much time into it that you do not want to end it. Her behavior is the reason you might fiercely defend a social or political ideology without knowing any of the actual facts. Simply because everyone in your circle believes it, you are believing it too. Confirmation bias is what blinds you to the fatal flaws in your own business idea. You can't change your human nature. You will always feel the fear, the FOMO, and the need to fit in. But if you can build the systems to recognize and outsmart these biases, you won't just become a better investor, you will become a master architect of your own life. If this story sounded a little too familiar, hit the subscribe. Let me know in the comments which of these 5 traps has cost you the most, and whether that was in the market, business, or your personal life. See you in the next one. Until then, be value smart.